Every branch I ever ran started the week with a meeting before the doors opened. We would gather in the back, the district manager on a speakerphone, and there was a whiteboard. On it was a list. Not a list of the people who needed help that week, a list of products, with a number written next to each one. And that number was how many of them we were expected to sell by Friday. And the easiest names to sell them to, the names we quietly circled first, were the loyal ones. The widow who had banked with us for 30 years. The retired couple who still came in on a Friday just to say hello and check their balance in person. They trusted us completely, and in that back room, their trust was the line on the board that made the number. I sat in those meetings for 22 years. I was handed those quotas. And today, I am going to read you the 5 things we were trained, specifically, to sell to the seniors who trusted us the most. Let me be fair before I am hard, because most of the people across that desk from you are decent. The young teller who opened your account is not the villain. She is 24, she has a number to hit by Friday, and she is reading a script someone above her wrote. What you are up against is not a bad person. It is a system built very carefully to turn your loyalty into someone else's quarterly target. And it works best on the people who have stayed the longest because it never feels like a sale. It feels like service. It feels like the bank you have trusted for 40 years looking out for you. So you say yes, the way you always have, and you walk out feeling cared for. The whole machine depends on that feeling. Here is my promise for the next half hour, and it is just one thing. I am going to show you the 5 products that sat at the top of that whiteboard in the order we pushed them, ending with the one that did the most quiet damage to the most seniors. For each, I will tell you exactly what we were trained to say, why it pays the bank and costs you, and the precise sentence you can say back that ends it. Not a lawsuit, a sentence. Almost none of this asks you to be tough. It asks you to know which box to uncheck and what the friendly name really means underneath. And this is not one wicked bank, which is exactly why I will not name one. A few years ago, one of the largest banks in this country was caught opening millions of accounts in customers' names that they never asked for, so that employees could hit the numbers on a whiteboard exactly like mine. The fine ran past $185 million, and when the regulators went looking for the cause, they did not find a few bad apples. They found the quota. That is the public record, and the pressure that produced it is sitting in every branch in America, pointed most often at the customer who trusts the most. And understand how that pressure reaches you, because it is not one greedy decision. It rolls downhill. The region gets a goal, the branch gets its share, and every morning we stood at that whiteboard and accounted for it. We even role-played the conversations. If a customer says she is happy with her account, here is what you say back. If he says he needs to think about the annuity, here is how you keep him at the desk. We called it overcoming objections, which is a polite way of saying we practiced, out loud, how to talk a hesitant senior past her own good instincts. Hit your number and you were praised on the call. Miss it and you were coached, which is a polite word for pressured. None of us thought we were bad people, and most of us were not. But we each walked onto that floor with a number we had to get out of somebody, and the somebody who said yes the easiest was always the one who had trusted us the longest. There was one kind of customer we quietly dreaded, though, and I want you to become him. Call him Frank. Frank read everything. Frank asked what it cost. Frank was not rude, he was just awake, and Frank was almost impossible to sell to. By the end of this, you are going to be Frank. One tool before we start, because you will use it more than once, and most people have it backwards. When a bank charges you a fee, there are 2 completely different doors to get it back. The first door is a favor. You call, you are polite, you ask them to reverse the fee as a courtesy for a loyal customer, and a lot of the time they do, because keeping you is worth more than $35. That door is discretionary, so you ask, you do not demand. And if the first person says no, you politely ask for a supervisor. The second door is the law, and it opens only for one thing: an actual error or a charge you never authorized. Report that within 60 days, and the bank has 10 business days to investigate and put the money back if you are right. Keep those two doors separate, because through this whole list I will tell you which one to use, and using the wrong one is how good people get told no and give up. A fee, very often, is just the bank's opening offer. Let me show you that first door working, because people assume a fee is final, and it almost never is. A Frank I knew got hit with a maintenance fee after a deposit landed a day late. He did not storm in. He called, stayed perfectly friendly, and said one thing: "I have banked here a long time. This fee caught me off guard. Please reverse it as a one-time courtesy." The first person said they could not. He did not argue. He said, "I understand. Please put me through to a supervisor who can." The supervisor reversed it in about 90 seconds, because to a bank, keeping a long-standing customer happy is worth a great deal more than $35. That is the whole first door. It runs on patience and good manners. It works far more often than anyone expects, and the only people it never works for are the ones who never ask or who hang up at the first no. Now, the whiteboard, from the bottom up. The first thing, the gentle one, the one that feels like a reward, is the upgraded checking account. Every bank has a friendly name for it: Premier, Relationship, Advantage. The teller looks at your long history and says, "You have been with us so long, you really should be in our relationship account. It is our better account for our better customers." It sounds like a promotion. It is the opposite. Your plain checking, the one you have had for decades, charges a small monthly fee you almost certainly never pay, because it is waived the moment a direct deposit lands, and your Social Security check is a direct deposit. The fancy account charges a much bigger fee, around $15 a month instead of $5, and it waives that only if you keep a much larger pile of money sitting still. So they move the loyal customer out of an account that was effectively free and into one that costs $180 a year, unless you freeze a few $1,000s in place to dodge it, money that is now earning the bank interest instead of earning you anything. That is the whole trick. Not a better account. A fee you did not have, dressed up as a loyalty reward, and on the board it scored as an upgrade. I think of a man I will call Walter, 70 years old, same plain account since the Carter administration, never paid a fee in his life. They moved him up with his cheerful permission. He did not keep the big balance that waived it, and for almost 2 years, $15 a month left his account, while he felt like a valued customer the whole way through. Nobody lied to him. He was simply moved into a paid account and told it was a reward. The counter move here is the easiest on this entire list. You say, "I would like to switch to your basic checking account with no monthly fee." Then you ask the one question that ends the game for any account they ever try to move you into. What is the monthly fee, and what exactly do I have to do to make it zero? If the answer is a balance you cannot comfortably keep every single month, you are in the wrong account. They will not offer you the downgrade. The whiteboard has no line for it. You have to ask. And the second thing on the list is not gentle at all, and they made it worse just last year. The second thing we were trained to sell was overdraft coverage, and this one is engineered down to the order your transactions post to take the most from the people with the least room. Somewhere in your opening paperwork is a choice about whether the bank covers your debit card when you come up short for a fee or simply declines it for free. The law actually requires you to opt in. You have to say yes. And opt-ins were a number on our board, so the script was, "Let us turn on overdraft protection so your card is never embarrassingly declined at the grocery store." It sounds like a courtesy. It is a trap that costs about $27 a swipe. And many banks post the day's charges from largest to smallest on purpose. Picture a tight day, a little money in the account, and 5 small purchases. Run the big one first. It drains the account, and the 4 small ones each bounce, and that is 4 fees instead of 1, maybe $100 in a single afternoon off a few small buys. Banks paid hundreds of millions settling lawsuits over that reordering. And just when it was finally getting reined in, the rule that would have capped these fees at $5 was killed in Washington in the spring of 2025. So right now, in 2026, the cap is gone, and the fees are back to whatever the bank wants to charge. The rules did not get better for you. They got worse this year. Americans still pay around $12 billion a year in overdraft and related fees. That is not a rounding error. That is a business. I watch this land on a woman I will call Ruth, on a fixed income, careful to the penny. One low month near the end of her check, a few small things hit on the same day, a larger automatic payment did. The bank ran the big one first, on purpose, and every careful little purchase bounced. Ruth, who had never overspent in her life, walked away owing more than $100 in fees on less than $50 of coffee and groceries, from a coverage a nice young man had signed her up for years earlier without her ever really understanding she had agreed to anything. The counter move has 2 parts. First, you opt out. You say, I want to opt out of overdraft coverage on my debit card and ATM withdrawals. Then, if you ever come up short, the card is simply declined, which costs you nothing and embarrasses no one. Second, if a fee already hit you from a real error, that is the second door, the law. You report it within 60 days, and they owe you an investigation. Do not beg for that one. Claim it. The first 2 things cost you in monthly nibbles. The third thing waits, quietly, for years, and then it costs you all at once, on a date you forgot was coming. The third thing was the certificate of deposit, set to renew automatically. A CD itself is a perfectly honest product. You lock your money up for a fixed rate. The trap is one little setting, the automatic renewal, and we were trained to make it the default, because money that rolls over stays in the bank at the bank's rate. When your CD matures, you get only a short window, usually 7 to 10 days, called the grace period. And only in that window can you take your money or renegotiate the rate without a penalty. Miss it, and it locks itself back up for another full term, at whatever rate the bank is quietly offering that day, which is very often worse than you could get by simply asking or by walking across the street. Picture a widow who locked in a certificate a couple of years ago, back when a safe CD finally paid close to 5%. She did the responsible thing and walked away. 2 years later it matured. The notice came in looking like every other envelope from the bank, and she set it on the pile. The window opened and it closed, because nobody calls you for this, and her money rolled itself over into the bank's renewal rate, by then back near 3%, locked away again for 2 more years. On a serious balance, that is hundreds of dollars a year walking quietly out the door on money she handled carefully. She was one phone call from keeping her rate, and the system was built so the call never occurred to her in time. So you make it occur to you. You write the maturity date on the kitchen calendar 2 weeks early, and when it comes, you call and say one sentence. Do not let this renew. I want to review the rate first. Then you shop it, because the same government insurance protects your money at the bank across the street that is paying twice as much. And the fourth thing renews itself quietly in the background too, and when I finally added it all up across my years, it shamed me the most. The fourth thing was the add-on. The little monthly subscription we bolted onto a card or an account with a soft, reassuring name. Credit monitoring, payment protection, identity theft coverage. A few dollars a month for peace of mind. Activations were a tracked, easy, beloved number because a few dollars a month sounds like nothing, and most people, once they say yes, never look at it again. That is exactly the point. It is designed to be forgotten. A few dollars a month on millions of accounts, year after year, for a service the customer rarely uses. And this is the single most documented thing on my whole list. Over the past several years, regulators ordered bank after bank, some of the biggest names in the country, to refund customers who had been billed month after month for monitoring and protection plans they were never actually given. Not products that were a bad deal, products that were charged for and never delivered. The refunds ran into the hundreds of millions of dollars at a single bank. So when I tell you to look for this on your own statement, I am pointing you at the thing the regulators themselves had to step in and claw back. The counter move you can do tonight. Take your most recent statement, paper or on the screen, and read it line by line, slowly, looking for any small recurring charge with a word like monitoring or protection or plan in it that you do not remember using. When you find one, you call and say, "Cancel this add-on and refund the recent charges. I never used this service." And if it turns out they were billing you for something never provided, that is the law door again. Even better, do this on apparent statements, because that is where a forgotten few dollars a month hides for years. Now we are at the top of the whiteboard. The fifth thing had the biggest number next to it, earned the branch the most, put the most at risk, and it was aimed, on purpose, at the customer with the most to lose. The loyal saver with money sitting safely in the bank. The fifth thing we were trained to sell was the move out of your insured savings and into an investment product, usually an annuity. Slow down with me here, because this is the one that can genuinely hurt a retirement, and it is sold with the warmest smile of all. A loyal customer, a widow, a retired couple, has a chunk of money sitting safe in a savings account or a maturing CD insured by the FDIC, money they can reach any time they need it. And to that customer we were trained to say, "Your savings is barely earning anything, but we have a product that pays so much more. Let me introduce you to someone at our investment desk." It sounds like the bank doing you a favor, steering you toward a better return. It is the single most profitable referral in the branch, and it moves your safest money into the riskiest place it has ever been. Because here is what stays off the warm side of that conversation. An annuity is not a deposit. It is not insured by the FDIC. It can lose value, and it very often comes with a surrender charge, which means if you need your own money back in the first several years, you pay a steep penalty to get it. I knew a widow, and the story is far too common to belong to just one person, who moved her safe savings into an annuity a trusted face had gently recommended. And then about a year later, her roof failed, and getting a chunk of her own money out early cost her a painful bite she never saw coming. The money that had been 100% safe and reachable was suddenly neither. And the person who steered her, the friendly face she had trusted for decades, was not her fiduciary. Hold on to that word, because it matters more than any other word in this video. A fiduciary is legally required to put your interest first, ahead of their own paycheck. The person at the bank selling you that annuity is not held to that standard. They only have to believe the product is suitable, not that it is better for you than leaving your money exactly where it was safe. The gap between suitable and in your best interest is wide enough to drive a retirement through. So here you do not just uncheck a box. You protect yourself with 3 sentences, and I want you to actually memorize them. Before you sign anything that is not a plain savings account or a CD, you ask, first, is this insured by the FDIC, yes or no? Second, is there a surrender charge? And if I need my own money back in 2 years, what does it cost me to get it? And third, the one that changes the whole room. Are you a fiduciary, legally required to act in my best interest, and will you put that in writing? Watch what happens when you ask that third question. If the answer is anything other than a clean yes with a signature behind it, then the person across from you is a salesperson, not an advisor. And the safest thing your money can do is stay exactly where it is while you take a few days to think. There is no annuity on earth that is a good deal only if you sign today. Pressure to sign right now is, all by itself, your answer. And that one question, the fiduciary question, is the master key to this entire video, because it works on all 5 of these and on every product they invent after this one. It cuts straight past the friendly name to the only thing that actually matters. Is the human being advising me legally required to put my interest ahead of their own paycheck? Yes or no? In a bank branch, across the desk from the warm face you have known for years, the honest answer is almost always no. Let me give you the customer who got this right, because she is who this whole video is for. I will call her Margaret. 40 years at the same bank, the kind of customer who reads her statement at the kitchen table with a cup of coffee and a pen. When they tried to move her up to the relationship account, she asked what the fee was and what it took to waive it, and then she said, "No thank you," and kept her simple account. When the annuity conversation started, she asked her 3 sentences, and when the man could not say yes to the third one in writing, she smiled, took her brochure home, and never went back to that desk. Margaret did not get loud. She did not threaten anyone. She just stopped saying yes automatically and started asking what the friendly name really meant. And the next statement that came to her kitchen table had nothing on it she had not chosen. No relationship fee, no overdraft surprise, a CD she had shopped instead of let roll, no add-on she had forgotten, no annuity she had been talked into. She ran her finger down the fee column, found nothing circled in red, set the page down, and did not have to call anyone because there was nobody left to fight. That is the whole point of this. Not anger at a young teller doing her job, not a war with your bank, just the quiet power of a person who has decided to read the board before she signs. Everything they were trained to sell you depends on you saying yes the way you always have, out of trust, without asking the one question that turns the lights on. The relationship account dies the moment you ask what it costs. The overdraft trap dies the moment you opt out. The rollover dies the moment you mark your calendar. The add-on dies the moment you read one statement all the way down. And the annuity, the big one, dies the moment you ask a man if he is a fiduciary and watch him fail to say yes. And if you have said yes to one of these, or to all 5, do not spend a single minute being embarrassed. You were not naive. You were loyal, in a world that learned how to bill loyalty. You were never powerless in that branch. You were just never shown the whiteboard. Now you have seen it. So before I let you go, I want to send you on a small treasure hunt. Because after everything I have told you about money quietly leaving your account, you deserve one place where money might be quietly waiting to come back. It is called unclaimed property. Old accounts, forgotten deposits, a final paycheck, a refund that bounced back. When an account sits untouched long enough, the bank does not get to keep it. By law, it eventually hands the money over to your state, and your state holds it, waiting for you to come and claim it. There is something like $70 billion sitting in those state offices right now, and roughly 1 in 7 Americans has some of it. It is free to search, and it is free to claim, and no one at any bank has any reason to remind you it is there. So tonight, after this, go to your own state's unclaimed property website, type in your name and your spouse's and your parents', and see what comes up. People find old paychecks. People find forgotten savings accounts. Come back to the comments and tell me what you found, because I read them, and I promise you somebody in that thread is going to find real money they had forgotten they were owed. And tell me one more thing while you are there. Tell me which of these 5 they tried on you. The relationship upgrade? The overdraft opt-in? The rollover? The add-on? Or the annuity at the desk? The one that comes up the most is the one I will take apart next, all the way down to the exact words they use and the exact words that stop it. You spent a lifetime trusting that branch. The least it owes you is the truth about what was written on the wall. I was in the room. Now you know what was on it too.